Well, good afternoon, investors, and welcome back to Bull Sessions. This is our mid-October 2025 edition. My name is Mark Robertson. I'm founder and managing partner of Manifest Investing. I'm joined here by three people that I've been investing with and comparing notes and sharing ideas for a long time.
Thank you.
In decades. First of all, Ken Kavula, our magical mathematician. He's no longer wearing a zipline attire.
Hello, everybody. Hi, Mark.
Then we're also joined by Kim Butcher from Florida by way of Indiana. Good afternoon, Kim.
Well, hi, everybody. Looks like I'm out dancing with the bull.
There you go. We're trying to figure out who that is. If that's you, okay. It could have been Elaine Bennis with the rhino there. And last but not least, Matt Spielman from Houston. Good afternoon, Matt.
Good afternoon, Mark. I guess am I the guy pointing at whatever's behind the rhino? Is that what happened Monday? The rhino sat on, or it happened Friday?
Kind of what happened to the market on Friday, right?
Yeah.
Took a seat for sure. All right.
So many lessons for one picture.
All right. So it is a bit of a tease, but we are going to talk about stock selection guides and how I've been doing them wrong for 33 years. And Ken and I have been comparing notes on this. I think you'll find it interesting. We're also going to tackle some Buttonwood transactions and then continue our best small company hunt for our shopping list for Halloween coming up. Anything else you'd like to add to the carnage on the screen, Ken?
I think we should get going here, Mark. Let's see how many seconds it takes to do the disclaimer, okay?
Okay. Is the disclaimer next? It is. So start the stopwatch. All right, the most important thing to remember, no investment recommendation is intended. This is entirely about an educational demonstration of principles and philosophies of the modern investment club movement. Make your own decisions about everything. And if you have any questions or suggestions for future topics, or if you'd like copies of the slides from today's session, send an email to either of the two of us at the email addresses shown on the screen.
You're keeping it under 30 seconds. That's wonderful, Mark.
Okay.
Let's move on. Okay?
Let's just keep moving on. All right, here's our brief.
If we could keep this slide under 30 seconds, we'll be in good shape,
okay.
All right?
All right, way too much ketchup on the right. Sad Portillo's hot dog. Stock price that used to be at anywhere from 12 to 19 is now at 6. And just some carnage on the left there. And I snuck in some good news on MP Materials, one of our best small companies from the past, doing fairly well in the rare metal stuff. The Portillo's summary at the bottom does show that, this company probably should do better ultimately, but we'll see. I didn't make 30 seconds there, but whatever. All right. So here's just some brief themes to go over. Yes, I'm a turncoat. That is a Costco hot dog. So Portillo's is going to blacklist me. But a whole bunch of retail stuff and apparel type things in the current quarterly update. A lot of stuff going on in the market with China and AI. Like I said, we're going to talk about paying a little bit of attention to who's actually buying a whole bunch of stock lately. And your clue is the 800-pound gorilla in that picture. And we will do a little bit of Buttonwood. And yes, we will spend with, and I'll talk more about it in a few minutes, I think this might be becoming my favorite source of small company ideas. The Vanguard ETF shown on the right, ticker symbol VTWG. Any comments, Ken?
No, I like your pictures this time. You got lots of animals this time, Mark. You're just really branching out here, so it's great.
Yeah, we even got the T. Rowe Price. I believe that's a ram of some kind.
I think it's a ram, yeah. Uh-huh.
And Ollie's on here, too. And your company, TJ Maxx. All right, so here's our characterization of the market that we look at weekly. And Ken, I'll let you take it away. I mean, we were above the red line, and then Friday.
Well, it kind of reversed itself. I don't know exactly where we got all the numbers from Monday, because I think our markets were closed yesterday, but we got some exceptional numbers from U.S. stocks trading around the world, I guess. And then Today, the last time I looked, the market was actually a little bit positive. So we might have that line back up to the line of expected return. That's that long-term average of somewhere around 10% that we've seen happening in the stock market for many, 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 many years. It's been moving a little bit more steeply recently, but long-term, 9.5 to maybe 10.5 or even 11 is a really good measure for how the stock market does over long periods of time. I don't think there's much else to say except that Value Line and the Manifest Investing database, as far as PAR is concerned and as far as PROVE is concerned, all seem to be clustered very tightly together. Not quite as tightly as they were last week, but still tight enough for my purposes and for my thinking. And that means that things are pretty well behaved in the market at the moment.
Yeah, and that is that lag. They have to turn in their homework before Friday afternoon, so basically those prices taking a dive to the downside on Friday, possibly pushes that up if they were real time. All right, so let's go ahead and press on. This is just a nice reminder from Ben Carlson that every time we have a Friday like we did with a day where it's down 1% or more in a single day, it's not unusual, and we should never be surprised by it. And you can see that as of this point in the year, we're at 22. We have another 9 down days left to get back to average for this year.
I think what was so exceptional on Friday, as far as I was concerned, Mark, is I was listening to a couple of the news channels, a couple of the business news channels that I was switching in between, and all of them were talking in terms of numbers of points that were down. Very rarely did I hear a percentage being mentioned.
Yeah.
And when the indexes are as huge as they are, the declines can be significant in points, but when it's around 0.75% or 1/10%, it's not something that's uncommon. And this is a great chart to just remind people that stock prices go up and down all over the place.
And they do. And every once in a while, you get some shopping opportunities. All right, moving on to performance perspectives. Again, we're looking back at what is virtually a 10-year look back for most of the entries on the screen. The exceptions are the demonstrations, the Tin Cup demonstration, which is a retirement plan demonstration, which is cooking along fairly well. The round table has kind of recovered back into that 2 to 3% beating the market range. And we hope to see that continue going forward. And Ken, I'm sorry to report that a little dip back at Buttonwood puts them back at the bottom of the chart here.
Well, we're going to tinker with it today and see if we can begin to fix that a little bit, Mark.
Fix that long term. Definitely testing our patience and resolve here over the last couple of years. And of course, the rule of 5 here really does apply if you start looking at the 2 at the top, the 2 companies at the bottom, and then the 6 in between. It really is fairly reasonable distribution. We're going to spend a little extra time on the Russell Growth ETF that you see mentioned here.
It hasn't helped Buttonwood one bit, Mark, when we've decided to open a new portfolio as the market took off and did 20% plus for almost a 2-year period either. So
yeah, but we're supposed to be good enough to do better than that. So
well, we just made it really tough. Okay.
yeah, why? It's like starting a marathon a half hour after everybody's gone. Anyhow. All right, just a quick reminder. I think it was Matt that shared that this was out there. Josh Brown and the Compound and Friends did a really nice session with Peter Lynch. I was actually kind of skeptical because sometimes Peter can be a little bit dry, and he really was good in this session. And I think Josh Brown brought out the best in him. And it's out there. You can find it on YouTube. The link is up there at the top. And
I will say, Mark, that this is about as mellow as I have ever heard Peter Lynch speak. In all the years I've been investing, I've listened to him lots and lots, and this is about as mellow as I've ever heard him. He actually made an attempt at humor a number of times, and he hit the nail on the head a number of times, which I think was a real good thing.
Absolutely. It's a good session, and I think you'll take away some nuggets from it for sure. And here's one that Matt shared to give us just a little perspective. So Matt, I'll let you, what do you see here?
Well, yeah, the point comes from the Financial Times, and there is a link in the forum about it. And I think the Financial Times will give you 5 free articles to read, so you can read it. But I also have a link to the Yale Budget Lab for the data behind this. So there's a lot of discussions, and even more in other online forums I am about the devastation AI will place upon the workplace. And it certainly is going to change the workplace. It's going to change the content of work. But kind of like when we talk about recessions or any other market characteristic, right? This has happened to people before, and it will happen again. So I can't explain to you how Yale comes up with a metric of occupational mix in percentage. Is that the jobs change, job content change? It's kind of a complex thing. But we can see 2 prior, certainly significant technological waves that came through with the introduction of personal computers. I wouldn't put computers at 1984, but personal computers would. Of course, that was the year of the famous Apple Macintosh ad that they ran once too.
Mm-hmm.
And then the advent of the internet. And certainly there are job types that even in my work experience that started in 1993, I know don't exist anymore, but it's really incrementally different, not entirely different from those. And then after that was the joke. I've heard a lot of people talk about, you're not going to be replaced as a customer service representative, salesperson, insert the job. You just need to be able to use it. So I would still say it's better to be the farmer than the horse in that picture. Although to stretch the analogy even further, because I've heard this before in other comments about organizational change and going from horses to motorized vehicles. In 1910, there were 27.5 million horses in the United States. Any guess how many there are today?
About the same.
27.5, Matt. Am I close?
No, it's in 2023 there were 6.65 million horses.
Oh, okay.
So certainly not as part of everybody's everyday life, but by no means gone.
You gotta clue us in the future here, Matt. We thought we were going to be good straight men for you. Okay.
I know. Well, I think it really is a valid thought, because I can remember back to the mid 1990s, and the internet was going to either kill us all or save us all or whatever. And, whatever scale or component that you measure on that y-axis, you're basically talking about impact. And, you've got early adoption and then a fairly steady progression of impact in the graphic. And I think you could throw one more up there, the advent of the motion picture industry, 50 years before that, where, and Ken, I don't know if you either read or would share. I mean, there were people that actually thought that the motion picture industry was going to do damage to the school system.
Well, I thought you were going to ask me about the talkies. So.
Well, that's true too.
That too.
To go further on that timeline, that's what people thought about the VCR too, right? That was going to be an end to the movie industry. Because people could just watch it at home. How many times has it been said, people can just watch it at home with whatever improvement in the home experience there has been?
Absolutely. All right, pressing on. Update on the Groundhog Challenge. And everybody's cooking along pretty well. We still have 2/3 of us beating the market. Interesting goings on here. I mean, the small and medium companies took a pretty good hit again collectively, and many of the Magnificent Seven took off, and that gap had narrowed to a couple of percent. It's back at 8%, and so the high flying magnificent stocks at least have recovered that. I mean, they took Friday off. They got hammered on Friday, but they still continue to roll. So
lots of familiar names on the list, and And a lot of jumbling up this particular week. For a long time, we were seeing the top 10 or 12 stay pretty consistent, but a lot of jumble up there, a lot of big moves. I'm going to have to audit that one move from that guy with going from 48 to 30. But other than that, well, we're doing pretty well, I think, you know?
Yeah, despite Oracle misbehaving. No, I'm kind of it's been a while since we've seen the club entries drift down the list like this. So I don't know what that says about the market in general, but the group entries are fading a little bit, with the exception of those motivated investors from Michigan up at number 2.
Well, like I said, I'm going to have to take a screenshot of this and make sure that they get a copy of this, because a lot of them are still paying my Social Security, so that's a great thing. They can't come to a 2:00 in the afternoon event. So
there you go.
We
Yeah.
do love all those people who keep on working, so that, because my parents used to tell me, keep working, Kim. I need my Social Security check.
And of course, our big movers from this week happen to be a couple of college students who are boyfriend and girlfriend. They're actually the grandchildren, or at least one of them is the grandchild of one of the other groundhogs in the contest. And yes, they are doing the long distance thing, with one of the two at South Florida and the other one at Vanderbilt. And Caleb and Bryn, I think they could actually be names from Outlander, but that's a story for another day. Here's a look at their dashboard, and I found it kind of interesting. They have quite a formidable collection of stocks, and they'll show up in a number of portfolios. By the way, NVIDIA, the moves in NVIDIA were causing a lot of that turbulence, Ken, on the previous page.
Well, I'll tell you, anybody with Oklo in their portfolios just been very, very happy. Yeah. I wish I would have had it in my portfolio, but somebody suggested I use nukes rather than Oklo. So
that's right. You're safer because of it. You just poor.
I'm safer. Okay. All right.
You have less assets to worry about. But yeah, Oklo is up 400% basically for Caleb and Bryn. And I just wanted to show that they did have one holding that actually our site picked up an old ticker for Service Master. It's not Service Master. It's actually Serve Robotics. The ticker symbol is correct at SERV. And I had no idea that that's what this particular company was doing. But it's cooking along fairly well. And I'll see if we can't add it to coverage. And then of course, we'll beg Kurt to try to let me back in to edit the site again.
Mark, you and I know, or you know, that Natalie and I live up near Frankenmuth, and Frankenmuth has a really large new Korean restaurant that opened up there. I know it makes no sense for little Bavaria to have a big Korean restaurant, but they do. And running all around the restaurant are about a dozen of these robots that carry food back and forth, and they carry checks back and forth and do all kinds of different duties in the restaurants. First time in a long time that we had seen anything like that in any restaurant anywhere.
Yeah, I'd be fascinated to see if there isn't some footage, or I assume this is actually out in public, and it talks about driving, self-driving delivery. So maybe we get Matt rolling on this one, and we have this year's laser. Knocking on wood, running for cover. All right.
No, Vital Farms, okay?
There you go.
Vital Farms, that's working. All right, let's switch to Buttonwood and talk about some transactions at Buttonwood. Again, this is, I think it's a fascinating graph. You wouldn't do this weekly, but we have, just to get it up and rolling, where we're taking a look at a couple of things. The blue line is the balance, simply the balance in the account. We add $100 every month to it. The green line up at the top, also denominated against the left-hand y-axis, is the future value, if we're right about the projected returns for the individual positions. So we basically stack those up. They're moving in the right direction. The red is the overall portfolio par, which we're attempting to maintain in the sweet spot. 4, 5, 6% above the average market return, which Ken showed you a couple slides ago, is right at 9%. So we would love to be in that 14% range. And then the gold with the black circles is the actual annualized rate of return, which we were getting almost giddy about, and it did take a little bit of a breather. Western Alliance took a bit of a hit, as did Lulu, but and a couple others. But interesting, positive progress that's kind of fun to watch over time. Any thoughts on this, Ken? Are you more comfortable?
I still am in agreement that this is a chart that bears some thought, and that it's forcing both of us to remind ourselves what's important in a portfolio. So I don't see anything wrong with looking at something that's doing not what we want it to do, and that gold line, that orange line, whatever color it is certainly not doing what we'd like it to do, and therefore our goal is to turn that thing around and move it back up towards 10, 11, 12, 13 if we can.
Yep. Stock prices fluctuate, and our patience is tested from time to time, so we shall see. We are up today slightly, so good stuff. All right, here's a look at the portfolio. What would you give it for a report card, sir?
Well, I'm looking at the par value, and I'm looking over here at my par. My par is 9.2, and our par value in the portfolio right now is 13.4. So that's a good 4 points plus to the upside. That's a great number. I still would love it to be in the sweet spot, which is 5 to 10 points above average, which puts it in that 14.2 to 19.2 range right there. But, beating the market by 4 points plus is not an easy thing to do when you're putting a portfolio together. And we're trying to put a portfolio together that is not full of 15 very, very risky stocks. So we're trying to have a margin of safety. We're trying to have some really good diversity. And I'm very pleased with the par the way it is, although I would love it to be just a touch higher if we can make it go there. That par, we feel, is directly dependent on growth. That's sales growth, by the way, folks. And our growth in the portfolio, that's a weighted average of the sales growth numbers of all the SSGs that make up the portfolio. And it's at 12. And we've shown you week after week after week that the very best mutual funds that are growing at +5 to the market are also growing their sales in the 13.5 to 14.5 range. And so while 12 is a great number for sales growth for the whole portfolio, I think we'd love to boost that up maybe another point and a half if we possibly could. Quality is excellent. The PE ratio is well under control. That speaks to risk. We don't worry too much about yield, and the financial strength and EPS stability numbers are in the top fifth, and that's where we like to keep them if it's at all possible to do so. So overall, a good solid with honors portfolio, but it's not going to come in magna or summa cum laude at the moment, Mark.
Okay. Well, we'll see what we can do about that, or at least make it even more dicey. Who knows? Pretty good performance up at the top from Google and Taiwan with the run in the technology stocks. And we're going to talk about Lulu down at the bottom. It is the smallest position in the portfolio and probably delivering an outsized amount of frustration. All right.
So we have 14, 15 stocks in the portfolio, 15 with Lulu. And that means that an average position is going to be 6 2/3%, let's call it 7. And half of that average position would be something that we'd keep in the portfolio at a bare minimum, twice that average position. And we got to start thinking a little bit about maybe trimming something. That doesn't mean you sell the whole thing. That doesn't mean you have a terrible company, but you don't want a tail that dog can't drag around. So all in all, nothing is in too bad of trouble as far as diversity, as far as size is concerned. We do have quite a variance in par values. So we'll be looking at all these things in the next few moments and trying to come up with some recommendations.
Yeah, these are sorted from the highest, which would be probably the best buy candidates for study at the top end. The lower end are the holds, and I can't even approach sell. Everything is basically at market or above for the most part. We do have 3% in cash at 4%, but and the proof reconciles pretty nicely. Quality's fine. We've been over all this stuff. Again, we're going to always have our eye on the lower growth rates in the portfolio. We have kind of a manual stop on Gentex. If it actually takes off and reaches a level where the relative strength index on a price surge gets up in that 70 range, we probably would exit the position, just because it's just been awfully it's getting more cyclical all the time. It's always been a growth cyclical, but that's going on. So at the very top of the chart, got a couple to look at. Green brick is interesting. Nice is also interesting with the events in the Middle East. Ken's going to talk about that. But let's take a closer look at some of the stuff. So here's Lululemon.
Yeah, I want to point out one more thing before you get off that slide, Mark, and I think it's important that you start to look at your return forecast and compare it to your sales growth. The two columns are separated on the chart here, but Lululemon, for example, has a par value or return forecast of 24%, but it has a sales growth forecast of under 9%. And I think a lot of times when you see that kind of disparity, the same kind of thing is happening with Gentex. When you see that kind of disparity, sometimes you're looking at a greatly undervalued company that's going to grow much, much faster in return than it can in sales. But often you're looking at a company that might be experiencing some growing pains or might be experiencing some turbulence. And I think you want to be real careful when those two numbers diverge as strongly as the numbers for Lulu and Gentex are diverging right now.
Yeah, I would agree with that. I mean, it's either very undervalued or it's a situation that's unraveling a bit. In the case of Lulu, and it's a little early in the year to think tax loss motivated selling, but I mean, we're down significantly versus the market with Lulu and actually have a capital loss. And like I say, a little bit early in the year to think about it that way, but we can certainly bank it against some of the gains that we had taken earlier. So let's take a closer look at Lulu and kind of what's going on here. This is what Ken is kind of getting at. Is it a value trap or is it an undervalued opportunity? I tend to think that, some of the wheels are coming off. The quality's coming down. This elevated return forecast, again, this could be a trap. I mean, you could get sucked in by that huge return forecast of 24%. You can see even the proof is at 31%. So it could be a bit of a trap if conditions continue to be more and more challenging. The sales have definitely hit a plateau of sorts. Slowed down from what we saw 10 years ago. So they have definitely plateaued. I would draw your attention. Value line may be overly pessimistic, but this is their 3 to 5 year projection. You can see that it has dipped considerably. So I don't know. Anything else on here that causes you concern, Ken?
Well, it's more experiential and anecdotal than anything, Mark. But I've been investing for a good many years in a lot of different clubs, and my experience with fashion has always been that it's very unpredictable, and you always would like to see a company that specializes in fashion be able to have a solid 3 to 5 year projection out into the future. But my experience with a lot of these companies is that you just can't make a forecast that's that long because fashion changes so quickly. And what was hot yesterday is not necessarily going to be something that's hot fashion-wise tomorrow. it's not like selling a lot of different products that do maintain their consistency. The quality doesn't seem to matter quite as much with fashion as it does with a lot of other things. So
I agree with
I
that.
think there's a lot of warning signals here on this chart that I'm perfectly happy with getting rid of this Lululemon out of the portfolio.
Yeah, and I mean they're facing tariff challenges and manufacturing challenges globally. They still make a great product. It's used by an awful lot of principally women. Although Ken did talk about his tutu a while back, but we don't even want to go there.
No, Ken didn't talk about it, but that's okay.
But yeah, here's that traditional warning signal with cash flow, and it just simply indicates challenging conditions or strife in operations. The cash flow has actually turned and gone. It's not gone negative, but it actually has declined a bit. You can see it has broken trend. In addition to that, the profitability, whether measured at the operating level or the bottom line known as net margin, that has also shown signs of pressure. Now, I will say, Ken, that if we exit this position today, these will dramatically improve. So just be ready.
That's been our experience for the last year and a half, Mark. So let's see if it holds. Okay.
So we will go ahead and consider that. And then just one quick look at Western Alliance, because they've been in the news over a couple of things which we think are not terribly consequential. But Ken, why don't you brief the audience on some of the concerns?
Well, I don't know if most of you follow banks very closely, but we had an asset manager, to give it a kind of a generic name, called Fortune Brands, which went out of business, went bankrupt.
First Brands.
And I'm sorry, First Brands. Thanks, Mark. And the general tenor of the news was that Western Alliance held a large amount of what was going to disappear in the bankruptcy. Western Alliance replied very quickly to those innuendos and rumors, and I've done a little bit of tentative research. I'm the stock watcher for Western Alliance in a couple of the clubs that I belong to, and my conclusion is that even if Western Alliance is liable for all of the negative things that will fall out of First Brand's bankruptcy, it will take a relatively small hit on its bottom line, on its earnings, and for that matter, on its revenues, because First Brands made up a very small piece of Western Alliance's business. My sources seem to indicate that Western Alliance will be liable for a very small piece of what First Brands is going to leave on the table. And none of the rational sources that I've consulted seem to be especially worried about what that particular bankruptcy is going to do for Western Alliance. So at the moment, barring any further news or barring any further information, I think that this is a non-starter as far as an issue is concerned with this bank.
Yeah, I think, even going back longer term, and this is kind of kicking at an old dead horse, but this moment in time right here was caused by the sort of thing Ken is describing. We woke up one morning to a couple of California banks being in tremendous difficulty because private equity firms had pulled their money out, and Western Alliance went from 80 to 8 in a matter of minutes. And it was a day that many of us remember quite well. I bought shares at 8, and I still hold those shares. So, I mean, it just shows you how crazy things can get, because Western Alliance came on a few minutes later and said, wait a second, we don't have that kind of business in California. It can't affect us that much. And, everybody basically said, oh, yeah, tell us the truth, all that. Eventually it came out that, no, they did not have that exposure. So, yeah, the type of stuff that hits the news can create, in this case, it was a massive opportunity. Could have gone the other way too, but in this case, Sometimes the stuff that is out there in the media can actually present an opportunity. The one thing I would mention with these guys, Ken, is their profitability has been suffering a little bit. They are down to about 1% return on assets. It'll be interesting to see what 2025 checks in with. And hopefully,
Yeah, again, it's not home free, and I do want to make it clear that regional banks have been the poster child for major problems in the financial sector, but those problems have been relatively isolated at the moment, and Western Alliance seems to have a clean bill of health, even though as it grows, some of the measures that we like to see higher have been lower. We are doing our due diligence in the clubs that own Western Alliance. One of the clubs has already done a pretty comprehensive stock study of 6 or 8 of the top banks, in our opinion, and our conclusion was that we were better off holding Western Alliance than perhaps any of the other ones in the study. And that same study is being completed by another club that owns it, and I'm kind of predicting the same outcome is going to come after looking at basically the same data only 2 or 3 months later.
absolutely. And Morningstar, obviously, this is a graphic from Morningstar, obviously agrees that there's nothing terribly unusual going on. So we'll just leave it at that. All right, here's some shopping. If we decided to take proceeds from Lulu, the sale of Lulu, and go outside the portfolio, I would note that Nice is already in the portfolio. I don't know if we have Vital Farms yet, but
No, we don't, but Deckers is in the portfolio down right there, Mark. Yeah.
Matt will talk us into that eventually.
Yeah, so we do have at least, well, we have 2 on this list already in the portfolio. I've been drawn because I've been studying for the last 3 or 4 months, Mark, a stock called UFP Technologies, relatively small company in the medical device area, but they're not making medical devices. They're making packaging and containers for these medical devices. Either the container will help you dispense whatever happens to be packaged, or it will help protect whatever happens to be packaged. So it's a medical device company, but not really.
Okay.
And I kind of like the par value for it. I especially like the sales growth possibilities for a company that has a nice history. And I like these up, straight, and parallel kinds of smaller companies. If I were not to tell you what the sales were for this company in the past fiscal year, you would look at the graph and say, well, that's a good, solid, medium, or even large company with extremely consistent sales and revenues.
Yep, and you'll probably hear more about that one as the month goes on towards Halloween. And Ken, if you're starting to think about Christmas ideas for me, I'd like to own a Ferrari.
Okay.
Hang on to that thought. All right, so let's go ahead and
take that under advisement. Okay.
I'll send you a reminder. All right, here is the worksheet, and this is basically the proposal that we would like to go ahead and put together. We'll go ahead and demonstrate the worksheet if I can jump out, get it to a point where we can actually look at it. And you'll see that I have way too many dashboards. Sorry. Oh, looking for Buttonwood. Went too far. And then I will increase the size of it so that people can see what we're doing here. So there is the portfolio. And we're going to demonstrate basically what we call the sandbox. Go into the worksheet. First thing I'm going to do is reset it to make sure everything is current. And Ken, so you want to go thumbs down on Lulu because you're tired of it.
Yep, so just press that green button next to Lulu and we'll just make it inactive for the moment.
Okay, so it's in purgatory.
I don't know if you were watching, folks, but the cash down there has been increased now by that 160 some odd dollars that Lulu was worth. So it's keeping track of our cash for us that we have available to spend.
And your first thought was because you can't get away from apparel retail apparently, and buy that Ferrari.
Well, we've really liked Deckers, and it's not a high fashion brand or anything, but it's a good solid shoe company. Just a nice, good old boring up straight and parallel that keeps making money. So let's buy one, I think that's right, one share of Deckers.
Yeah, and I did do some field research at a grandson's soccer game and found that 6 out of 10 ladies were wearing Deckers products on the sidelines. So we should be in good shape there.
All right.
All right.
Uh, uh, I have a theory that a lot of what's holding NICE back, and this is a business service company that is very highly regarded by the rating agencies and by the companies that use it. They do business services for some of the largest firms in the world. I happen to have a feeling that even though their sales are increasing in a nice, consistent manner, positively, and their earnings are increasing the same kind of positive increase over 5 or 6 years, not just a little bit of time, but their stock price keeps moving in the opposite direction. The only thing I can see that causes that is their location, and they are a Tel Aviv Israeli company. And I think being in the middle of that conflict, which we hope is maybe coming to some kind of a head right now, being in the middle of that has caused folks to be a little bit jittery about putting money into the company. I'm going to suggest we buy another half share of NICE, Mark. That would bring us up to 2.5 shares. And folks, if you're watching the cash again, every time we put a new stock number in there, the cash adjusts itself. So we're down to $154 and change right now. And then I would suggest buying 3/4 of a share of this UFPT. That's not on the list at the moment, but if you go up to the upper left-hand corner and press that plus sign.
That's what I did. And we've got it over here on the right now.
Oh, and Mark's fielding UFPT over there and putting in a 3/4 of a share and going to submit it. And now it's on the list as well. And that takes us down to $7.95, which will hold until our next cash infusion comes into the portfolio. And if you remember, we were down around 13% on par value, and we've moved now to 13.5% on par value. That's a nice increase with a small amount of change. And we've actually increased our growth by a tiny bit. We went from 12% even to 12.1%, again, moving in the right direction. And we did that without destroying the quality number, without destroying the financial strength or earning stability number. We kept those at rates that we consider to be very good or superb. So I think that this is some minor spending of our cash, putting most of it back into stocks we already owned, and then beginning a new position to replace the position that we sold. So we're still going to stay at 14 stocks. 14 or 15, I'm not quite sure which it is now. Mark's going to go up in the corner and save it to original. And now that becomes our new dashboard. It's missing Lululemon, and it includes now UFP Technologies.
Okay, and we walk away with a little bit of a tax credit for next year's taxes. Good stuff. All right, so we will go ahead and lock that in. Get back to the regular presentation. All right, let's go ahead and switch gears a little bit. Talk about this notion of better stock studies. My confession is that I've been doing this for a long time. As most of you know, I do a lot of stock selection guides. Is that a fair statement, Ken?
That's very fair.
Like a lot. And My confession is I'm not so sure I have been doing them as well as I could. And what we're going to bring your attention to is this notion of buybacks and the impact on stock selection guides and how you think about this phenomenon as you do your studies. And we'll call it prudent attention, because we don't want to admit to being wrong about this, but understand the trend. Understand the trend of the capital structure of your company. And just seems prudent to me and reasonable. So here, just for a little context, again, it is the 800-pound gorilla in the room. This is a trend that has been increasing for quite some time. And this buyback activity. And you can see a couple of entries there. One recently from Morningstar on the upper left, and that's actually an Investopedia summary towards the middle of the page in a Wall Street Journal article. These are all fairly recent. And again, I think you can agree that that's an increasing trend on the right. So again, we're not saying, it's not so much as doing it wrong for 33 years, but this is a condition which has changed a little bit, and we have to take measure of it and decide, how important is this to really bring to our studies. So is that enough confession for you, Ken?
I think it's enough confession, Mark, and I think it's recognizing the fact that in the 50s, 60s, 70s, even into the 80s, dividends played a much larger part in portfolio design than they do today, and stock buybacks were practically unknown during those times. As we moved into the 2000s and then the 2010s and into this decade now, we've noticed and kind of an increasing trend for companies to buy back stocks. I can remember at the National Convention 12, 15 years ago, we started to hear classes being offered to our members of better investing that were suggesting that stock buybacks might be the precursor to something that's going to be very common into the future. And there was a lot of debate about whether they were good for shareholders or not. And that debate has kind of slowed to a point where I think that the general analyst population is beginning to feel that these might have been a reasonably positive kind of trend. I'm still not sure myself, but it's reality, so we have to deal with it.
Yeah, and we're not necessarily answering the question, because we can point to a number of purchases by companies when it didn't seem like a terribly good idea to buy back even their own stock. And that can actually be a flag that you might want to set that management free. So we're not answering that question here today. We'll probably tackle it. I mean, Sharon Saras did provide a really nice AI-generated summary of this, and we'll be taking a look at that. We're just talking about the impact of what's happening, not passing judgment on it. And here's where it comes to play. This company is a community favorite. And again, if you're like me, for years, first of all, I use a preferred procedure for virtually every single stock study that I do. And that's true for manifest investing also. And what I generally have done over the years is, kind of crank through, think about the judgments all through the preferred procedure. I get down to that shares outstanding entry and I go a little bit lazy. And maybe I'll take a glance at Value Line and see that they've got 44 or 43 for future shares outstanding. I might use that number. And you can see that leads to a certain EPS growth rate. Okay, and then over to the right, all the numbers are exactly the same with the exception of this one. And this is what Ken and I were talking earlier today. I don't remember the last time I did a stock study where I'm cranking along looking at a company that's been, the shares outstanding in the data array are like 49, 48, 46, 47, 44. I don't remember the last time I entered 32, Ken. Do you?
I don't adjust quite that much unless I have a really good reason to.
Okay.
But you're right, Mark. I will look at value line. If I'm doing a stock study for a stock that I'm the stock watcher of, I might even go to the company and look to see what they've said they're going to do, and then try to figure out what they've actually done, because a lot of times companies say they're going to buy back a lot more stock than they actually do.
Very true.
But that's about as far as I'll go. I think you're suggesting that if the buybacks are consistent, then we might have a different judgment in this particular box in the preferred procedure.
Okay, so what if the 32 is a reasonable and prudent number? I would argue that the difference between this number and this number is meaningful. It's from section 5 of a stock selection guide stock study. That's how big of a difference we're talking about here, gang. And what it comes down to is this situation. This is that company. And what you're basically looking at here is a number of 32 over here. And the company, you know, this is one of those things where it's really hard when it comes to a growth curve or any type of this is a semi-log paper. It's tough. And what you see happening here is a company that has gone from approximately 60 million shares outstanding down to around 40. And if I'm doing this study today without looking at this piece of information, I'm probably doing 40. Okay? Not this 32 and a half. But what we're really talking about here is, again, everything Ken said was spot on, because they don't always do what they say they're going to do. But in this case, we're looking back at what they actually did for the last 6 or 7 years. And Ken's going to expand on that a little bit. But what we're basically asking is the question, well, what if they keep doing what they have been doing? And that has been a fairly reliable trend for a large number of companies. Is that 32 credible? And it turns out it actually is. If you really sit back, look at this information. And again, as I say here, I'm not comfortable with this notion of I'm not predicting. It's not exactly predicting. It's simply saying, what if they keep doing what they've been doing? And here, the potential difference really makes a difference. And then you can actually take it to companies that are buying shares also. Your NVIDIA's, for example. And it actually tightens up studies. Your thoughts, Ken?
Well, the only warning signals that I think we have to flash when we're talking about forecasting something that's been happening in the past is to make sure that it's actually been happening fairly consistently for a fairly decent amount of time. If that decline had only been happening from 2025 to 2026, in other words, just 2 dots on the graph showing a decline, I would be very, very hesitant to want to predict that's going to continue for the next 3 or 4 years. But when you can put together a string of 7 data points that line up the way these are, I think you have a reasonable shot at saying, it's probably more predictable than not that they're going to continue that trend into the next 3 or 4 years. You have the ability to throw this graph right onto your analysis tool. If you're a Better Investing member and using the SSG Plus, you can throw the numbers of shares at the end of any fiscal year right onto your graph, and you can see how consistent that growth is. And if it's a nice straight line like this one, then I think you need to ask yourself, is that line more apt to continue or not? If you can line up 5, 6, 7, 8 dots in a row, then I think the chances are that it will continue, and you should be using a lower number of shares. And if the line's tilted the other way, growing instead of declining, then you maybe need to be using a larger number of shares 5 years into the future than you're doing right now.
That can be very important for an early stage company or a very rapid growing company that is literally printing money by issuing shares. I mean, that's what they're doing. All right,
I think
so
they would say raising capital, Mark.
they might, but they're printing money. So this is what it comes down to: is as we go through the data migration back to value line data, we're going to use this as our metric. We're basically going to use the value line data to drive these type of analyses. The regression that you see on your screen it's a forecasting algorithm. That's as deep as I want to get into it, except to say that, let's say, for example, for 2025 and 2026, they tap the brakes and they do slightly less buybacks. That will have an outsized impact out here. And Ken wanted me to make this point. The forecasting algorithm that we're using, again, it's very similar to the one the value line uses for other metrics. If they tap the brakes, it'll have a large impact on what happens out at the end of this. So it'll be kind of interesting to watch as we go through the data. But I was surprised by the difference, and it's something that I just simply want to be more personally aware of. I think it will be globally helpful to all of us as we crunch through this stuff.
Yeah, we're both going to be thinking about this for the next 6 or 8 or 10 months, and we want you to be thinking about it also, and give us some feedback. If you're finding that manifest numbers are really different in the return values than the numbers you're putting together on your own analysis, let us know these things because it's important that we start to deal with the analysis in a way that reflects what's happening in today's stock market. And I think that we have to recognize the fact that things have changed in the stock market significantly since the 1940s, and we have to begin to fold some of that into our thinking.
All right, so really quickly, let's just go ahead and talk. These are the 20 companies we chose last Halloween. They continue to beat the market by a decent margin, and we only have a few days left, Ken, so hopefully we're okay. We'll just leave
You're
it
just
at
tempting fate by putting this screen up, Mark. That's all.
I am. That's why I buzzed through it really quickly. Again,
Good,
as I said, the Vanguard total, the Russell 2000 Growth ETF, especially when you set aside some of the companies that don't yet have positive earnings, is looking pretty compelling. And here is our current list of companies. So again, in order to make the list, you're going to need to be a company growing in double digits with a pretty decent par or projected return on value approved. And so that's what we're going hunting for with this particular ETF. What I was able to do is go back and just enter, it's almost 2,000 companies, just threw the ticker symbols at it and put together a couple of charts. This one's pretty key. This is one of the reasons I think it's an important stopping point for us as we do our Halloween shopping. The bottom line says it all. And what's really cool is we have a few of those in the portfolio for this year, for the trailing since last Halloween. And if we had only listened to Betsy Wills, Ken, she wanted to put Joby and hims and hers into the portfolio, into the best small companies, as you will probably recall. Good stuff. Jinxing things. Of course, here is our number one performer up at the top. Shh. All right. So again, going through, and again, with a switch back to the value line data, we're able to import this stuff pretty quickly. And so we have a quick look at some of the companies in the Russell 2000. Try to avoid companies that don't have positive earnings for 2025. I did give a reprieve if they had positive earnings for next year. Anytime Ken sees those parentheses in the earnings column, he breaks out in hives. So we're going to try to limit those for sure. But the important column here is the growth forecast column, sorted from highest to lowest. Interesting that we've got some financial strength numbers for many of these companies, as well as proof. So we're going to be shopping in this field, looking for companies with 15, 20% growth rates, decent financial strength. I don't think you'll see too many C++ make the cut. Ken's already tried to get me to remove this one, but I left it in because it was actually in the forum this week. It does have only 8 million in sales, by the way. So Rigetti Computing, the top performing company, by the way, last year.
Lots of press. Lots of press.
Lots of press, and apparently some of it quite controversial. But
Yeah.
we'll be looking for those sort of things. So here's kind of the top 20. Any favorites jump off that page at you, Ken, that you think might make a run
Well,
at the final cut?
I fully believe when Nicholson said you can put 15% of your portfolio in non-traditional investing, because I want people to understand that I own a couple of these that I would never put into a growth portfolio unless I really had a good concept of what I was trying to accomplish. So I own Oklo all by itself, not in nukes, and I own New Scale Power, not in the NUKZ mutual fund or ETF. I own those as individual stocks.
I've got this
My
one.
wife puts them in her portfolio, and they've performed admirably for me in the last year and a half, and I'll continue to own them for the moment. But there are a few that I really kind of am interested in at the moment. I like the TGTX down at the bottom. It's a therapeutics, doing some very interesting things with designer kinds of solutions for orphan diseases. I like Mama's Creations. That's a food company.
A
Meatballs.
Jim Gallagher selection.
Meanballs. I like that particular one. I like KRYS. This is doing work with particular types of diseases that are related to multiple sclerosis and that type of disease. They actually have a working drug that they're making money from, so they actually have pretty decent earnings. The par values for these three, however, are not particularly appealing to me. In other words, the market has discovered these companies and given them either very fair par values or even a little bit deflated par values. And remember, when the par value deflates, that means the company is maybe overvalued and doing quite well in today's market. So there's some good names on this list. Our top performer from last year, the one that is just going to end the contest in a couple of weeks, is Credo. And it's just way out in the stratosphere this year. I happen to own that third one on the list. So I own three of these very small, non-traditional investments. I'm looking for traditional investments on this small company list, and I think there's some that exist on the list.
Absolutely. And here are, again, we're just going through roughly some of the shopping opportunities. They're sorted by their growth forecast. That could change with an audit also. And we avoided any companies below a B for financial strength. And some interesting companies here. A sushi company. Might have to try to warm up to that, Ken. That one appeared last year, and they actually had a fairly decent year. This Clover is kind of annoying because I'll take a look at it, and Ken will talk me out of it. But yeah, some interesting companies along here. I do find it interesting that Transmedics might be a little bit pricey. You can see that the proof is down to 5.2, but these statistics are all pretty good.
Yeah, notice there's no par value column right now because a lot of these you can't come up with a par that makes a lot of sense, but there are proof values for many of them. And so I'll start my searching by looking at the highest proof values. I'll look at Pagaya Technologies, and I'll look at Remitly Global because I have no idea what those companies do. And maybe I'll discover the next Crudo, or I'll discover one that I want to put in my own portfolio and that I might want to include on our best small companies list as well.
Yeah, this one's probably a little bit lukewarm to make it, but I find at least interesting to study. DigitalOcean Holdings, real earnings here, Ken. Projected anyhow. Current and projected. And we'll take a look. But yeah, going down this list, there's a lot of new names for me and some good hunting.
Remember, if you'd like these slides, just send an email to Mark or to myself, and we'll make sure you get a copy of the slides, because these are screens that you can't immediately duplicate yourself. You might as well just ask for the slides, and you have all the tickers in a nice list to start with then.
And I'll probably post the final screening results on the forum also, so we'll have some fun there. All right, a week from today, we're going to actually do a special nighttime edition of Bull Sessions. Kevin Gologly will join us as we go back and revisit the emerging companies from the Hoover's Handbook. That'll be at 7 p.m. Eastern Time. And we had some fun with it last year. We'll have some fun with it again this year. Again, we go through them one at a time, not during the session, before the session.
Phew, thank goodness. Keep going.
and there's a few companies involved here. And as Kevin has pointed out, you can actually access library versions of these and get them secondhand. He has actually provided the PDF of the current book in our forum, so you can go there to get it. Found out just before we started the session that IBD Digital is back, so I wasn't going to take a look at the New America feature in IBD, but we will now because it's free for a week. So we'll probably cover that either next week or the week after. Here's your Rule Breaker Investing, the book by David Gardner. That's also out there. And then there's also an event, if you're a fool, coming October 24th, an all-day program with some people that we like to listen to, including both of the brothers, Annie Dean and Morgan Housel. So that's just out there for you to be aware of. We do archive these sessions on YouTube, Bull Sessions and Roundtables. And with that, I just want to share that apparently Ken is posting on Reddit under the name Upper Blackberry. Is that you, Ken?
No, that's not me, Mark. I don't know who that is, but I echo the sentiment, okay?
Well, if Upper Blackberry 685 posts something positive about Advanced Micro, we're going to talk. So,
okay.
So with that, hopefully you've enjoyed the session. We perhaps have given you a little bit heavier things to think about than usual, but hey, it's investing. Any closing thoughts, Ken?
Yeah, Mark, I have a topic for us for another day. One of the members of my Wolves Investment Club, Barbara Renford, Barb wants to know, could we take a moment to explain the difference between prove and par? And maybe we can do that at a future bull session in the next couple of weeks, okay?
Absolutely, especially as we use it for the Halloween selections.
And then we have George Mackey out in the audience making a great solution. If you were actually doing this kind of portfolio management that we did in Buttonwood today, if you were doing it in your own club, what you might do before you sold Lulu or in preparation for selling Lulu is you might look at 3 or 4 of Lulu's direct competitors, not necessarily selling yoga pants or selling athleisure, but competitors selling women's sportswear perhaps, or women's clothing. And you might see if this trend that we saw in Lulu is happening in all of the fashion, or if it's just happening to Lulu in isolation. And you might find a competitor that you like more than Lulu, and you might just trade one for the other then. George is suggesting an industry study, and I'm a great proponent of never studying one stock all by itself. Always study 3 or 4 competitors when you're looking at a single stock.
Great suggestion, George. We'll see if we can't emulate that for a future transaction. Good idea. All right. Anything else?
I think we're up to date on our list of questions here and everything, Mark. So I wish you and the audience a great rest of the day, and we'll see everybody. And again, remember, folks, next week's bull session's at 7 o'clock Eastern time, and we expect to see a lot of you there. We hope to see a lot of you there.
All right. Thanks, everybody. Take care.